Good morning, everyone, and thank you for coming. My name is Roberta Schaefer, and I'm the President and CEO of the Research Bureau. Today's program is part of the Research Bureau's Francis A. Harrington Forums, and we'd like to express our gratitude to Holy Cross College for hosting today's program. And it's always a pleasure to have one of our events at this lovely facility. And to greet us from the college is Michael Lockhead, who is the Vice President for Administration and Finance.
Thank you, Roberta. Well, on behalf of the President and the Board of Trustees, I'd like to welcome the Research Bureau and their honored speakers. Mr. Paul Willen, Senior Economist and Policy Advisor at the Federal Reserve Bank of Boston, and somebody who I've worked closely with over the course of my 4 years here at the college, and somebody for whom I have a lot of respect, Michael O'Brien, City Manager for the City of Worcester, Geraldine McCafferty, Deputy Director, Office of Housing, City of Springfield, their honored moderator, Brian Thompson, welcome, to the Hogan Center at the campus of the College of the Holy Cross. We're welcomed and pleased to have you. Your topic today, the housing crisis in Massachusetts, keeping the roof from caving in, is certainly timely, and the solutions to which will no doubt require tremendous effort and creativity of the Commonwealth's and the nation's policymakers. Despite being a private, undergraduate, liberal arts institution focused intensely on the education of future leaders, Holy Cross has not been immune to the impacts of the housing crisis. In our own small way, we've had to grapple with many of the issues that are being dealt with on a much larger scale today. The college supported the work of the Southwestern Neighborhood Improvement Corporation in their efforts to create affordable housing opportunities for members of their community by providing a loan guarantee through TD Bank North for a housing project on Cambridge Street. Obviously, given the fallout of the housing market, and in particular the subprime lending, these units have remained unsold and have put the college squarely on the hook for the performance of the loan. Certainly something that we had thought about but had not anticipated. The college has embraced the Mass Housing Partnership and their MassWorks program by offering incentives to Holy Cross employees to buy houses in the city of Worcester, and in particular in the South Worcester condominium complex that the college is backing. Finally, the college has renovated several houses that it owns adjacent to its campus in the hopes of providing housing for incoming faculty for their first 1 to 2 years here. Once they get their feet on the ground and they understand the area, we are fully ready to throw in housing assistance and provide additional incentives for them to live in the city of Worcester or the Worcester County. Our approach to dealing with the housing crisis on a very small scale has certainly absorbed a lot of management time and creativity. I trust that your time spent here today will help foster the kinds of dialogues that will improve the situation for our Massachusetts communities. It is my sincere hope that you will find the meeting accommodations pleasing and our staff accommodating during your time here. Thank you all for coming to Holy Cross, and please enjoy your day. Thank you.
We'd also like to thank Brian Thompson, the President of Commerce Bank and Trust Company, for providing the financial support for today's forum. The Research Bureau also wishes to express its appreciation to Bank of America for providing support for this series, Telegram and Gazette, and DBA Magazine for advertising it, and the City of Worcester Government Channel under the direction of Judy Warren for videotaping it. This event will be rebroadcast on Worcester's Government Channel 12, as well as on many other local government channels in the area towns. So be sure to check your local listing for rebroadcast. We'd also like to invite you to please visit our website, www.wrrb.org, where you can read and download Research Bureau reports, as well as announcements of upcoming events and highlights of past events. And you can be notified of new postings by sending us your email. The Bureau organized today's program because of the economic crisis we're facing and it's on everyone's mind. And it all started with the meltdown in the housing sector. Today's distinguished panel will discuss how this happened, what we are doing about it locally, and perhaps even prognosticate about when it will be over. It's now my pleasure to introduce Brian Thompson, the moderator of today's program. Brian is President and Chief Executive Officer of Commerce Bank and has spent his entire career in the banking industry. He joined Commerce in 2004, and prior to being part of Commerce Bank, he served as president of various banking institutions in New England. Commerce Bank has recently been accorded the special recognition of Blue Ribbon Bank by Veribank Incorporated, a banking analysis firm. The Blue Ribbon Bank Award is reserved for highly rated institutions that demonstrate exceptional attention to safety, soundness, and financial strength, and is the oldest national accolade presented to banks by private sector analysts. Commerce Bank is the largest independent banking company in the Worcester area. It prides itself on being a professional local banking institution attentive to the needs of the citizens and businesses in our area. In times of uncertainty, Commerce Bank customers can be confident that their bank is solid and strong and headquartered right here in Worcester. Brian joined the Research Bureau Board of Directors in 2008, and Commerce has been a long supporter of the Bureau, and we're pleased now to welcome them as a forum sponsor. Please join me in welcoming Brian Thompson.
Thank you, Roberta. Good morning. You know, I just a little advertisement before we start for Roberta. We are so fortunate to have her leadership at the Research Bureau, and with the leadership and the independency that she demonstrates, tackling some of the city's most difficult issues, providing insight and information so that informed decisions can be made. I'm sure our city manager would say that she provides good information, and at times probably there's a little nudge to them, but those are all good. But we're very fortunate to have you in our community and serving the role that you serve with the Research Bureau. I'm just going to provide a few opening comments. The stars of the show are over here, and I'm going to introduce them, and at the they will each speak for approximately 15 minutes, and then at the conclusion, we will have questions and answers. So we're going to have plenty of time for that, and I'm sure that their conversations will stimulate many of them. If I said in January of 2008 that the world would be historically different in 10 months, I'm not sure that we all could ever have imagined that we would be where we are today on November 13th. You know, we have Bear Stearns and Lehman Brothers who have declared bankruptcy. We have AIG, which was the world's largest insurance company that's basically owned by the government. We have Washington Mutual and Wachovia and Sovereign, who have all been sold, so to speak, but been helped by the government. IndyMac, out of business, one of the largest mortgage players. Most major banks throughout the world are seeking assistance from their governments to shore up their capital. And really only Morgan Stanley and Goldman Sachs exist in New York as kind of the leaders of in the securities business. The automobile makers are each struggling mightily today. The stock market, don't need to tell you, is down 35%. But all of these events affect people, financial security, their incomes, and their mental stability. And ultimately their ability to make their mortgage payments. 1 in 5 mortgages are reported to have negative equity today, or one of 5 families have negative equity. Delinquency is rising, and as you might have seen today, that foreclosures are up 25% from where they were a year ago. So we have a lot going on, and at the same time, there are a lot of people trying to resolve the problem and trying to fix the problem, although we're in uncharted waters. Citigroup, FDIC, Freddie and Fannie, are all large services, are offering programs to stem the tide. They're lowering interest rates, they're reducing principal, they're extending terms, all trying to do things to keep people in their homes. But things are happening so quickly that if you missed yesterday's paper, you may be a day behind. I mean, in yesterday's paper, Fannie and Freddie in a mood to forgive. Clarifying the new lingo of mortgages. And if I read through more pages, this is the Worcester paper, not the Wall Street Journal. So there's a lot of attention being paid to it. I think the good news is to say that in the end, we will survive. There will be another day, not sure exactly when or how it will look, but I think that we have a lot of very talented people that are working on the issues, and we will ultimately survive. It's my pleasure, and I'm going to introduce them in the order that they will speak today. Dr. Paul Willen is a senior economist and policy advisor at the Federal Reserve Bank of Boston. He has been there since 2004, went to Williams College and for his undergraduate, and then got his master's and his doctorate degree at Yale. He has been a lecturer and a professor at MIT, University of Chicago, Princeton. He has written extensively on various different subjects, written books. A couple of topics that I noticed, subprime facts. What do we know about the subprime crisis and what we don't know about it? Was a paper that he wrote. And I think one of his more interesting and recent was Negative Equity and Foreclosure, Theory and the Evidence. And so he is going to be our first speaker today. Our second speaker is well known to all of us. Mr. City Manager Michael O'Brien was appointed Worcester City Manager in 2004. Over the last few years, he has made significant strides to reorganize and reform government to address our community's most critical needs, and has worked tirelessly to rein in the skyrocketing costs of employee health care, saving millions of dollars for the city of Worcester. Under his leadership, Worcester is rated one of the safest communities in the country for its size. He has introduced new ways of doing business, new technology, and has successfully addressed the long-term financial stability of New England's second largest city. Most recently, City Manager O'Brien initiated Buy Worcester Now, a new private-public partnership between the city, banks, credit unions, local companies and nonprofit agencies, legal firms, realtors, and the state to generate new market demand for all available housing options in Worcester, and to assist responsible buyers in the purchase of a home. Simultaneously, Mr. O'Brien initiated a proactive plan to stabilize neighborhoods affected by national and regional market trends, in particular mortgage foreclosures, establishing 5 neighborhood revitalization areas focused on issues relative to housing, code enforcement, commercial storefront improvement, and job training. We in Worcester are most fortunate to have his leadership for those areas are critical. All these areas are of critical importance to our city. As being a participant in the Buy Worcester Now, I can say that his leadership, his vision, and his energy took this concept that he had and drove it forward into what has become a very successful program, which I'm sure he'll discuss in his remarks today. So we will have our city manager speaking second. Thirdly, we have Ms. Jerry McCafferty, who has been the Deputy Director of Springfield's Office of Housing since 2006, where she is responsible for policy and programming in the areas of foreclosure, fair housing, and homelessness. Jerry has a master's degree in urban and regional planning, as well as a law degree. Prior to taking her current position with the City of Springfield, she worked as a legal service housing attorney for 15 years. We are pleased to have you with us this morning. So with that, I'm going to turn it over to Dr. Willen.
All right. So I'd like to thank the organizers for inviting me. I know that Brian has seen at least part of this presentation before, so I apologize to anyone else in the audience who's heard these jokes before. So I just want to start by saying that this is important now, that I'm speaking today as a researcher and as a concerned citizen. I am not a representative of either the Boston Fed or the Federal Reserve System. you recognize this man. And I'm going to use the phrase we often, and by that I don't mean Ben and me. I mean some of my co-authors and me. I definitely don't mean Ben and me, or even Eric Rosengren and me. Okay, so the other thing I always say when I start these presentations, I've been doing these presentations now for about a year and a half, ever since, I can tell you when the foreclosure crisis started in New England, because that's when people started calling the Fed and asking for one of us to come and talk about it. And what I've learned is that that we're often wrong. I don't mean wrong, I like to say that we're wrong for the right reason, which is that you can look at data and you can look at figures and you can think about economic theories and you can, in all honesty, think you've found something and you can find out that you're wrong. But that's part of the learning process. And I found this quote in the internet. It came up one morning. It was kind of quote of the day. And of the day I was giving one of these talks. And it says, "No one who cannot rejoice in the discovery of his own mistakes deserves to be called a scholar." And I consider myself a scholar. I like to think of myself as a scholar. So we've been doing a lot of rejoicing in the last year. I'm going to talk today about a lot of research we've done at the Boston Fed. A lot of it is joint with other people at the Fed. There are some papers. Brian mentioned two of them. There's one more, and then there's one that I'm talking about. They're all available. These three are available on our website. And so if you have questions, most of the tables and figures that I'm going to show come from these papers. And so if you want more, find out more, with the caveat that it all could be wrong, you can go to our website. The first one is the subprime facts, and this is in order of comprehensibility. So as we move down, this one I think is aimed at a general audience. Then there's a paper called Negative Equity and Foreclosure, which is less readable, and then there's one that's totally opaque. Okay, so let me start by just saying a brief word about the economy. At the research department of the Boston Fed, actually, the main thing, housing was only a small part of what we did until recently. Most of what we're supposed to do is to think about the macroeconomy. But so let me just tell you a little about. I need to update this slide. Forecasts don't show growth in the third quarter. We know that growth in the third quarter was negative. We expect a significant contraction in the fourth quarter. Right now, people are talking about 2 or 3% negative growth in the fourth quarter. There really is no good news in the economy. The big problem is consumption. That's been a big problem now for the last 2 quarters. For the first time I've been teaching, and for the first time in a long time, when you're going over what accounts for growth in the U.S. economy, consumption is a big negative. In other words, without consumption, if consumption were growing sort of at the rates it's been growing in recent years, the economy would be growing. Everything, other sectors of the economy are actually doing okay. But the one big negative right now is the international side. So for the last few years, international, so exports, basically export growth, has been adding about 1% to growth. And the bad news is, and there was some news from Germany today, it's just an example of this, many of our trading partners are doing worse than we are, believe it or not. Europe seems to have gone into a recession even before we did. So the extra bonus we were getting from the international side just doesn't seem to be there anymore. The only this isn't good news exactly, but it should set your mind at ease that the role of financial crises in the macroeconomy is something macroeconomists within the Federal Reserve System and in the economics profession as a whole are very, very aware of. So, in fact, I'll just show you now, we actually have a history of overestimating the impact of financial crises on the macroeconomy. So this is forecasting experience with the 1987 stock market crash, but there's similar evidence when you look at data for the 1998 Russia crisis, for the 2001, for September 11th. We have a history basically of overestimating these things. And the way you need to read this picture, the blue line there is the forecast before the 1987 stock market crash. So this was in September of 1987. Then you have the crash, and these are forecasts. This is the Green Book, which is the Federal Reserve Board's official forecast. And so that was their forecast before before the 1987 stock market crash. Then the market crashes, and the two lines, the sort of orange and red line below that, those are their revised forecasts after the stock market crash. So they revised their forecast significantly down as a result of the stock market crash. But what you see is the green line there is what actually happened. And this is consistent in virtually every one of these crises. The actual is closer to what they forecast before the crisis than it is to what they forecast after the crisis. So the information of the crisis made them push their forecast away from what actually happened. And there are two ways of interpreting that. One is that we just think financial crises are more important for the macroeconomy than they actually are. Or another interpretation of it is that the result of our beliefs, initial beliefs that it's going to have a big impact, lead to a major policy response, which there was in every one of these cases. A major policy response, which is what prevents these bad outcomes from happening. So just one other thing about this, just in terms of the personnel, so in the early 1990s, there was a lot of research at the Boston Fed on credit crunches, on the role of financial markets in the macroeconomy. And there were two economists working there. One was a visiting professor at MIT who was visiting the bank, and the other was an economist at the bank. They're Eric Rosengren, who is now the president of the Boston Fed, and Ben Bernanke, who's now the chairman of the Federal Reserve. So the personnel are people who spent their whole lives studying the role of financial crises in the macroeconomy. So if anybody knows what's going on, and that's a big if, it would be Ben and Eric. Okay, so now I'm going to talk for the rest of this about foreclosures, and I'm just going to start by talking a little bit about the economic theory of foreclosures. So there's a lot of policy now driven by the observation that a lot of people have negative equity, that homeowners have homes that are worth less than the outstanding balance on their mortgage, and that's driving people into foreclosure. And it is absolutely true that negative equity is central to the decision of a borrower to default on a mortgage. But what it is a necessary condition. What I mean by that is that you have to have negative equity, basically, in order to end up in foreclosure, because if a house is worth more than the outstanding balance on the mortgage, people will sell it. And in fact, servicers will often force you to sell the house if you are routinely missing payments, you're deeply delinquent, and your house is worth more than the outstanding balance on the mortgage. They'll force you to sell the house to recover, and you'll make some profit on the sale of the house, and they'll get their money back. That is the necessary condition. What is wrong is when people then say, okay, not only is negative equity necessary default, but it's sufficient for default. In other words, anybody who has negative equity should default on their mortgage. Most people who have negative equity do not default on their mortgage. We went back to 1991. We have very good data here in Massachusetts. We went back to 1981, and we put together a sample of 100,000 people who, by our calculations, had negative equity in 1991. And then we were able to follow them over time, not just on that mortgage, but on any subsequent mortgage they may have had, to see whether those people ever ended up in foreclosure. Out of those 100,000 people, about 7,000 eventually lost their homes. So 93% of the people did not lose their home to foreclosure. Most people with negative equity do not default on their mortgages. Is this irrational? Some people, including some of America's most distinguished economists, have interpreted this as evidence of irrationality, that the rational, the cold-blooded thing, the right thing to do, what economic theory says when you have negative equity, is to default on your mortgage, but these people have some hang-up about how defaulting is immoral or something, and that's stopping them. That is wrong. Economic theory does not say that when you have negative equity, you should default on your mortgage. What it says is that when you have positive equity, you shouldn't default. Negative equity is not sufficient for optimal default, and that is true even, in some sense, especially true in a world in which there are no frictions. So it's not something where in the real world it makes sense to default when you have negative equity. And let me illustrate that by talking about two different people. The guy on the left is the president of the Boston Fed, that's Eric Rosengren, and some of you may recognize Ed McMahon. So what do these two guys have in common? A lot. They both are, if you've ever met Eric, he is a very sort of distinctive voice, as does Ed. Eric, one of the great things about Eric when he became president of the bank was you can always tell when he's around. When he comes down to the floor and say you're surfing the web, you can tell that Eric is there because his laugh, he has a very noticeable laugh, as does Ed, and they both have silver hair. Why am I bringing up these two guys? The answer is because they both had negative equity in their homes at some point. In Eric, this was in 1993, and for Ed, that was this year. What's the difference between them? Eric did not end up in foreclosure, and Ed did. So what is the difference between these two men? Why do we have such a different outcome? Even though they both had negative equity, why did Eric not end up in foreclosure and Ed end up in foreclosure? And the reason is, in finance we say that they have different stochastic discount factors. That, even most people in finance don't understand what that means, but it's actually quite simple. The difference is that when you're evaluating whether or not to default on your mortgage, what you're evaluating is not the decision it's not that when you default on a mortgage and you have negative equity, you're talking about getting that the bank. It's not that the bank is going to give you the difference between the outstanding balance on your mortgage and your house. Basically, the decision you're making is over whether or not to make a mortgage payment this month or not. That's the only decision you're making. It has nothing to do with the value of the house. Or the value of the mortgage. The issue is over that mortgage payment. It's irrelevant what the outstanding balance on the mortgage is because you're not going to sell the house. So the only issue comes down to whether or not you're going to make the mortgage payment this month. And that decision is a decision about you have to ask yourself how much of a strain making that mortgage payment is. And the trade-off you're making is that if you were Eric, he held on to his house. Today, that house is worth twice what it was when he bought it, and probably 250% more than it was in 1993. So by holding on to this house, Eric has made a huge capital gain. Now that capital gain came 15 years later. So it's not that he got that capital gain in 1993. So the choice he had to make in 1993 is, do I make my mortgage payment now? In which case, somewhere way down the line, I'm going to get a positive payoff. And that's the same choice that Ed McMahon is making. What's the difference, though? The difference is that you have to evaluate how much of a strain making that mortgage payment is right now. And for Eric in 1993, he was working at the bank, his career was going very well. That mortgage payment was only a small part of his income. He could afford the mortgage when he got it. His income was higher than it was when he'd gotten that house. And so for Eric, making these mortgage payments was not a strain. For Ed, making these mortgage payments, he had lost his job. It's not exactly clear what that means, but he had lost his job. He was sick, which is very typical of borrowers who get into trouble. And so making the mortgage payment meant that he couldn't eat. And that is the problem that most people face. And it's important to understand that even today, even in the subprime crisis, which everyone attributes to subprime mortgages, most people, the vast majority of borrowers who are having trouble, who are in foreclosure, are people who've suffered life events like Ed McMahon. They've either lost their job, gotten sick, or gotten divorced. Even now, it's not to say that we have more divorces now or more sickness, although we do have more job loss now. We didn't have more job loss a year ago. The problem is that when you lose your job or when you get divorced, under normal circumstances, you can just sell your house. The problem is right now we have a large group of people out there who, when anything goes wrong, they don't have any exit strategy. They can't sell their house, they can't refinance it, and therefore they go into foreclosure. And so that's the problem right now, and that has enormous implications for public policy and for what we can do to help borrowers who are in trouble. So let me just say a few things that do not cause foreclosure. And it's frustrating because a lot of these things keep getting repeated even by people in responsible positions who should know better. So one thing that you hear over and over and over again is that this crisis was caused by resets of adjustable rate mortgages. That is not true. 90% of the borrowers that default on their mortgages, of adjustable rate mortgage borrowers who default on their mortgages, are delinquent before the loan resets. That's the first thing. If you look at the performance of adjustable rate mortgages, the performance has deteriorated year by year. In other words, the 2006 mortgages were performed much worse 1 month after they were originated than the 2000 to mortgages. It's not that at 24 months, when the loan resets, all these people who are having no trouble making their payments up to that point suddenly have trouble making their payments. Another thing that you hear all the time is that the problem right now is financially solvent borrowers walking away from upside-down properties. Most mortgages are recourse loans. Lenders can and do pursue deficiency judgments. Massachusetts, as many of you know, is a recourse state, as are 42 of the remaining 50 states plus DC. So the idea that what's happening right now is that borrowers know that no one can come after them and they have lots of money and they could make their mortgage payments, but they've decided that it's better to default on their mortgage and go buy another house. There is almost none of that going on right now. That is not a sensible financial decision. Most homeowners that lose their home have suffered a life event. Finally, the problem, another thing that people have argued is that lenders that don't hold their loans on the books are the problem because they made, because they didn't care whether they originated loans that they knew were going to default, but they didn't care because they weren't holding those loans on their books. The practice of selling mortgages on the secondary market has been accounted for a majority of American mortgages since the early 1980s. This is not a new thing. If this were the cause of the problem, we would have had this problem in 1984, not in 2007. This has been going on. The practice of selling mortgages in the secondary market goes back. You can date it. You can see when it exploded. It was not in 2003. It was in 1981. And I'm now going to show you that the investors who bought these mortgages understood the risks in the mortgages. That wasn't the problem. What their problem was that they underestimated the probability of a large house price fall. So the idea that the investors who bought these mortgages didn't understand what a shoddy job the originators were doing originating those mortgages, the evidence suggests that they knew exactly what the lenders were doing. Okay, so let me talk about that now. Well, briefly, just a little outlook issue. This is really just in terms of the outlook. I'm not going to make a forecast because to make a forecast, we'd really need to know what's going to happen to house prices. But I'm going to just say that the way you think about this, it's important to understand the role of negative equity and the role of prices in foreclosure. So this is evidence about Massachusetts. That's the foreclosure rate on the top there. And on the bottom, we have the level of house prices in Massachusetts. And what's important about this picture, first of all, is to see that there's, of course, a good, strong relationship between falling house prices and rising foreclosures. That's the first thing. The second thing that's important to notice about this picture is how long the foreclosure problem lasted the last time around. So this is going back to the early 90s. We had falling house prices really from 1988 to 1993. Then house prices stopped falling, and they didn't start rising much, but they sort of started gently rising until basically they started rapidly appreciating in 1998. But what's important to see here is that the foreclosure rate stayed elevated. We didn't have a foreclosure crisis. We had a sort of chronic foreclosure problem basically through 1997. And why is that? Well, the important thing to note here is to look at where the cyclical peak was and when house prices recovered to that cyclical peak. And so basically, anybody who bought a house in 1987 or 1988 was underwater basically until sometime around 2000. And it's the stock of people. It's not, somehow people have this idea that we have a foreclosure crisis. It's going to be the next 6 months we're going to have a lot of foreclosures. We're going to have a foreclosure problem basically until house prices recover back to the peak that they achieved in 2005. That's basically what we're waiting for. And so long as we have a lot of properties out there with people with negative equity, any life event that comes along is going to push them into foreclosure. So we have a chronic foreclosure problem. We don't have an acute, it's not that we're going to have this just spike in foreclosures for the next 6 months and then it's going to come down. We're going to be dealing with this for a while. The good news is that I don't expect it to get vastly worse than it is right now in terms of a monthly flow of people into foreclosure, but I don't expect it to get significantly better either. Okay, so let me finally just talk about why we didn't see this coming, understand what it is, why this has been such a shock. And let me make a distinction between two different crises. The first crisis is a foreclosure crisis. So 7,000 people lost their homes in Massachusetts in 2007. There were 6,000 in the first 2 quarters of 2008. In the second quarter alone, there were 3,600 foreclosures in Massachusetts. That's the highest monthly total in our data, which goes back to 1989. The previous record was set in the fourth quarter of 1992 at 2,300. So this is bad. There were more foreclosures in the second quarter of 2008 than in the 6 years from 2001 to 2005, to 2000 to 2005 combined. Okay, there's also a financial crisis. Bear Stearns and Lehman failed. The stock market is down it changes every day. The banking system is frozen up. Boston Fed staff have been working long hours. That's really the main consequence of this crisis. But what I want to argue is that these two things are distinct and different crises. So the causes of the foreclosure crisis is that house prices have fallen dramatically across the country. As I've already said, there is a very well-documented empirical relationship between foreclosures and house prices, which, unlike many other empirical relationships in the data, is well-grounded in economic theory. People who buy this is not to say, when we say that house prices are the problem here, we're not saying that subprime isn't important. It's enormously important. Subprime, people who buy houses with subprime loans are 10 times more likely to lose their home to a foreclosure in a given month, and they're also 10 times more sensitive to falling house prices than prime buyers. So even though in Massachusetts house prices have fallen less this time than they did in 1988 to 1993, significantly less at this point, we have more foreclosures than we did the last time around. So subprime has played a profound role here, but it's subtle. It's in accelerating the effect of falling house prices, not in causing the foreclosures directly. Okay, the second crisis is the financial crisis. There are huge credit losses on subprime loans because of falling house prices. But huge credit losses do not necessarily cause financial firms to fail. So you guys all know about payday lenders, right? So payday lenders recover less than 50 cents on every dollar that they lend. So that's even worse than subprime home lending, right? Even the worst pools of subprime home lending, you get back more than 50 cents of what you earn. But these guys are profitable year in, year out. And the reason is because they price the loans right. If you're a banker and you're making risky loans, that's a perfectly reasonable thing to do so long as you properly price and reserve against those losses. So small business loans, there are all kinds of loans, credit card loans, in which there are large credit losses. But you can make money on them. So there's nothing intrinsic about making huge credit losses that leads to bank failures and leads to colossal failures on Wall Street. The reason these guys are out of business now is not because they made subprime loans. It's because they didn't price those loans right. It's because they didn't anticipate the delinquencies and foreclosures that they'd have on those loans. So the question is why these investors didn't see this coming. And there's a paper we wrote called Making Sense of the Subprime Crisis. That's not on our website. It was written for a Brookings Institution volume it's something called Brookings Papers on Economic Activity. And so let me just briefly go through what we found. The first thing is, one of the things you hear over and over again is that the problem here is that lenders made intrinsically crazy loans. And this quote is, and this is a joke, but this is what people say. It turns out poor people with bad credit can't afford to buy a home. Who knew? And the answer is, it's not absolutely clear that that first statement is true. That's not the evidence we have. So let me just go through. This is, I'm just going to focus here. We go through all kinds of different underwriting issues, but I'm just going to focus here on low documentation loans, since those have gotten a lot of attention. So low documentation loans were not the majority of subprime loans. The majority of subprime loans are fully documented loans. It was Alt-A, which is the area where most of the low doc stuff was. But what you can see here is that low documentation, there's very little no documentation. This is low documentation loans, went from about 20% of outstanding mortgages, of the mortgages originated, to about 35% between 1999 and 2007. That is the growth of low doc. But what's important here to see is that between 2005 and 2007, there was almost no growth in the fraction of loans, subprime loans, that had low documentation. Why is this important? It's when you look at what happened to those loans. So if the problem was that lenders started making low documentation loans, which are inherently crazy loans, then we would have seen that historically low documentation loans performed worse. But if you look at the data, you see that until 2005, full documentation and incompletely documented loans performed almost identically. There's almost no difference in the performance between those two types of loans. It's not the case that giving someone a loan with incomplete documentation is an inherently insane thing to do. As you can see, up until 2005, the two types of loans performed almost identically. It was only after 2005 that a gap emerged between them. But what's also important to see there is that it's not the deterioration in performance was worse for the incompletely documented loans, but it was pretty bad for both. So the idea that the problem here is that incompletely documented loans are a inherently crazy thing to do, it's clearly, up until 2005, there was no evidence that that was true. Okay, that's the first thing. The second question then is, what did the lenders get wrong? And what we're going to focus on, this is a little math here, is the rate of change of foreclosures. So basically what we're wondering is, why didn't they anticipate that foreclosures would rise over time? And we can really decompose that into two questions. Did they understand the relationship between foreclosures and prices? Was that what they got wrong? Or was what they got wrong the relationship between the evolution of prices over time? So did market participants understand the sensitivity of foreclosure to house prices? Or did they just not anticipate the fall in house prices? When we started this exercise, our prior belief was that their problem was not understanding the relationship between foreclosures and prices. So what did we find in the data? The first thing we did was just to look in our data. Let me go to this picture. In our data, had we been looking in our data, if we went back to 2004, threw out all the data that we had from after 2004, and went to our data and just looked at the data we had on subprime mortgages from 2000 to 2004, could we have guessed that this crisis was coming? And what we found was, had we known what was going to happen to house prices, we would have anticipated a dramatic increase in subprime foreclosures. And so to go back and say, oh, there's no way you could have seen this coming, if we had known, we were surprised by this, if we had known what was going to happen to prices, we would have predicted not quite 9% of the, in the real data, the people who bought homes in 2004 with subprime mortgages, 9% of them have already lost those homes to foreclosure. We would have predicted something like 8%, but that's bad enough. The question is, did they figure it out? So in other words, so we could have figured it out. Had we been looking and had we known, we might have figured it out. The question is, did they figure it out? And the answer is yes, they did. They did understand that a collapse in house prices would lead to huge credit losses. They were aware of that. Lehman Brothers wrote this meltdown scenario in one of their analyst reports in 2005, and they looked at 2005 deals. They said, if house prices fall by 5%, we will have 17% losses on these portfolios. Actual 2005 deals are expected to suffer 17 to 20% losses. So if they had known, this is roughly what actually happened, if they had known that house prices were going to fall by 5% a year, they would have guessed that there would be huge losses, roughly comparable to what we've had. So they would have predicted this. And there's a JP Morgan analyst report in which they looked, this was in April of 2006, they were able to figure out, even though they didn't observe falling house prices, they were able to figure out from, and I can just go to this picture here, they were able to look at the difference between high appreciation places and low appreciation places. The difference between those was enough that if you extrapolate, you would predict huge foreclosures if house prices fell. So one problem people thought we had was that we didn't actually observe any falling house prices in the early 2000s. So how would we have known how big the losses would be if house prices fell? And the answer is it was pretty easy to figure out, and in fact they did figure out that there would be huge losses. So what did they get wrong? What they got wrong was house prices. The consensus was that the decline on house prices in the order we have seen was highly unlikely. They pointed to the fact there was no national decline in house prices in history. That's what they said. The risk of a national decline in house prices appears remote. I went through, this was the Lehman Brothers, I mentioned this meltdown scenario. That was one of 5 scenarios they looked at. All of them, so 3 of them had 5% or higher house price appreciation. There's only this one meltdown in which they actually thought house prices would fall. And fortunately for us, in looking back on this, we can see what probability they assigned to the different outcomes. And what you can see here is they assigned 80% of the probability to 5% appreciation or more, and 15% probability to the extraordinary 11% annual house price appreciation, which is sort of historically unprecedented. What's remarkable is that meltdown scenario, they gave that a 5% probability. So they thought that there was 3 times more likely to have 11% appreciation than to have a 5% fall. Okay. And it took them a long time to accept that they were wrong. So this is from J.P. Morgan series called HPA Update. Over time, they were consistently optimistic about house prices. So they saw stabilization signs in December of 2006, more stabilization signs in 2007. House prices started falling sometime in the summer of 2006. They see this tentative stabilization in February of 2006, and so on and so forth. And it's not until November of 2007 that they finally accept that house prices are actually falling. And by then, they completely changed their story, and they accept another 15% loss. So let me just say one last thing. Everybody's going to ask always about the house prices. The truth is that we know very little about prices. So why did they have such a difficult time forecasting prices? And the answer is because economic theory and data tells us very little about house prices. So one of the things we do, people look at is the price to rent ratio, and they say, well, isn't the price to rent ratio, shouldn't there be some well-defined relationship between house prices and the rents that people are paying? And historically, there has been. This is over the period from 1987 to 2001, the price to rent ratio moved within a relatively narrow band. It started going out of that band in 2002. The problem is that you might say, well, if house prices are high relative to rents, that means house prices are going to fall. So in 2001, they were high relative rents. What happened? They went up more. Now they're really high relative to rents. What happens? They go up more. Now they're really, really high. They're way outside the normal bands. What happens? They go up even more. And so here we are in 2005, and you might have said, look, house prices have got to fall. But what do? They rise even more. So the point here is that predicting house prices is an extremely difficult thing to do. And everybody, economists, everybody, gets it wrong. So it's hard to do. That said, it's hard to see how you couldn't have at least, that you would have worried about the possibility that house prices were going to fall, which they evidently didn't. Okay, so let me stop there. I'm way over time. And so just to say, yes, the draft of the paper is available for anybody who's interested. And thanks for listening. Thanks.
Good morning. It's always a pleasure to be part of a Research Bureau forum. We all know the power of personality when it comes to Roberta, so for my own disclosure and for my own peace of mind, I like to at least believe that I made a conscious, free decision to participate in this morning's forum. I'd also like to thank Commerce Bank and Trust and Brian Thompson for sponsoring this event and being such a tremendous community partner and citizen, and I'll touch on some of that later in my presentation. I do want to speak briefly about Worcester's housing market, kind of from whence we came and some of the data that was presented earlier by my previous speaker. In our initial governmental response and community response and the early recognition of the problem going back to 2006. I think anybody in this room recognizes that the quality of life here in our community, as well as our neighborhoods, is defined by the vast array of housing options we have here. It's a backbone of our entire community. Owning a home, having a safe place with all the comforts that come with it are as close to the American psyche as baseball and apple pie. And here in Worcester, housing really is the fabric or the quilt of our city. In 2006, we began to recognize the trends that were described earlier. Fraudulent lending practices and a hyperinflated real estate market reached their peak, and the symptoms were more than obvious in a person in my role. Foreclosures had jumped from a low of 16 that year to a high of 190 by the end of 2006. And when you start to see those trends, there's no time for decision-making paralysis. It calls for action. As we talk and as we speak today, the numbers are surpassing some 1,700 foreclosures or intent for foreclosure here in our community. So it all has the potential to unravel what we all hold so dear, the downward spiral. And once it starts, it's almost impossible at times to slow. It's like a vortex. Foreclosures and abandonment, owners overwhelmed, and what we're seeing consistently is owners just walking away. Tenants without landlords, tenants in poor, unsafe conditions, private property conditions deteriorating, public safety jeopardized, it just continues, property values with the potential to plummet, tax revenues suffer, neighborhoods deteriorate, and ability for a community like Worcester to meet the basic needs of municipal services begin to suffer. Loan to values plummet in the banking industry, bank portfolios values plummet, abandoned properties, vagrancy, blight, and arson. Again, it's no time for decision-making paralysis. We develop a plan internally called SAVE, Stabilize, Assist, Value, and Enforce, just the first wave of response to this. What it required? Again, I had to look internal, strengthen municipal departments to address the crisis. We had to engage our neighborhoods. We had to engage the community for vigilant watches and changes in property status. Developed a hotline for problem properties and tight relationships with our Neighborhood Watch program. People in the trenches recognizing these trends early and getting us engaged early. We knew that we had to get involved with the tenants and get involved with owners to help them understand their rights and how we could actually help them help themselves with respect to foreclosure. And we got actively engaged with that. We also knew we had to help homeowners to seek immediate help in the face of foreclosure, many of them not understanding their options and what could be done, and working with community partners to make that happen. Starting with the reorganizing of municipal government, separated inspectional services from health and human services, focusing their mission on enforcement. Not punitive, but the reality is that all of us hold a level of responsibility to maintain and keep our neighborhood safe and our homes to standard. And that is, again, a reinforcement of the fact that we're all in this together. Joe McKillian is here. He's the Commissioner of Inspectional Services, now taking on that task day in and day out, and does a tremendous job for our community with his staff. We focused on stringent oversight of unsafe properties and problem properties, abandoned and foreclosed properties. Accountability and follow-through from the city manager right through to the inspector in the field. Centralize and computerize the entire process. So at any given time, we can track where we are in resolution to that problem property. We stepped up enforcement efforts across the spectrum with the City Council's support. We put in place a nuisance ordinance and a nuisance team. 3 people circulating the city every week right behind the trash route looking for these problems, whether in the public way or on private property, staying ahead of the problem before it becomes the crisis. We also put in place the teams and the efforts necessary to find the owners to comply with the code issues, and in some cases, when it's impossible to find that owner, put receivers in place with the help of the housing court because we simply cannot find those owners or find a bank that's responsible. We created an interdepartmental task force, the property review team, which I chair, which includes police, fire, code, treasury, DPW, law, and neighborhood and housing development. And these people show up at the meetings every week to take on these tasks and take the direction and think outside the box. And it does have something to do with the fact that I sign the payroll every week. That's not true. Very dedicated individuals on my team, and I'm blessed to have them. We developed from the ground up a comprehensive computer-based system, a property analysis database. It's unheard of. And when you look at municipal government, where everybody's standalone static data on property here in the community, whether it's police, fire, DPW, code, or otherwise, is now all being fed into a centralized database lifetime. That includes from the Registry of Deeds, it includes from PAMET, the public safety reporting systems. We had to go through all the necessary approvals to get this information. So at any given time on a specific property, we can bring up lifetime all the issues associated with that citywide. Again, being able to track trends, what the foreclosure issues are, even to the extent of understanding what the deeds data is, so we can look to and try to find who actually owns the property. And these are in laptops in the inspector's vehicles. So that we can track that information, again, eliminating redundancy, duplicative processes, and otherwise, to keep the process streamlined and keep focusing on accountability. And that includes re-inspections for compliance. It used to be that some of these issues, just because of pace and lack of accountability and oversight, we had challenges making sure that properties that had orders issued on them, there was actually re-inspections. And sometimes it would go weeks and months to get that property re-inspected. We now have that delay down to 1 day from the time that we've given a homeowner the chance to rectify the situation. That speaks to good government. I'm certainly very proud of that. Then took it a step further. And then we literally have sweeps of entire neighborhoods with that entire collaborative team that would go out. This weekend, I believe that we're going to be working in 2 specific neighborhoods with the entire city's enforcement team, from Department of Public Works right through to code, police, fire, looking for these challenges addressing these challenges before they become the cancers that eat away at neighborhoods. And we're seeing resolution in compliance. Thousands of orders responded to in time in bringing these properties to bear. These efforts also include the use of clean and lean. When we can't find an owner, the city's cleaning the property and we're leaning the property. Again, focusing on the broken window theory. We've got to address the problem before it's actually a cancer that takes the whole neighborhood. We also are making use of the state's receivership statute. This is key. Where we can't find an owner, they've literally walked away. We've appointed a receiver to take over that property, properly manage that property, keep the tenants in that home, keep them safe, and then when necessary, over time, look to transition that property to that receiver to manage it and own it from that point forward. And even the threat of receivership, where we've been working very close with the housing court, and my credit to them, when we go into the court with receivership, it's amazing how quickly owners come out of the woodwork to rectify those problems and bring that property to standard, keeping those tenants safe. So again, this is not punitive action on our part. It's about responsibility and all of us having a stake in seeing this problem and crisis resolved. Prevention efforts are part of this too, and we've got partners across the spectrum on there. We work with the state to assist households facing the potential foreclosure, letting them know what their opportunities are, what they can do to help themselves. And that's obviously working with Fran Paquette and NeighborWorks Home Ownership Center and also our local CDCs. The center's currently, right now, counseling more than 100 households on just that. And all of this is being done, obviously, to help them help themselves wherever possible and stabilize and mobilize our neighborhoods around the issues of foreclosures. But recognizing these trends, we took it a step further. Again, it's easy in a problem of this size and magnitude to get decision-making paralysis and to get overwhelmed by the nature and extent of the problem, as was earlier described. But in Worcester, I'm particularly proud of. It's about rolling up our sleeves and working together and looking to solve a problem. I came up with a concept, and as broad as I could describe it was, Buy Worcester Now. How do I engage all the community that I'm blessed to be able to work with to help solve what is right now the housing crisis of buyers that are out there that have the incomes, have the employment, have the credit history and otherwise, that want to buy homes but are like everybody else waiting on the sidelines, scared of what the future might hold, and hoping that the bottom of the market is ahead so they can take advantage of the lowest possible prices. No one benefits from that. So back in March, I conceived an idea to bring around those community partners around the table and begin to start to structure what Buy Worcester Now might look like. I brought local banks to the table that had a stake in local community lenders. They had strong portfolios. They didn't succumb to the run-up in the market. They did not take place in the greed and some of the other factors that resulted in the challenge that we have now. And they also had a stake in stabilizing our housing market because their portfolios contained good loans in neighborhoods that were at least had the potential to begin to plummet for values and safety because of foreclosure. And for all those reasons, they said, yes, we'll participate. Local employers, great corporate citizens, they benefit by having their employees take a stake here in our community. They benefit by stabilizing our community. They lower their carbon footprint. They offer these benefits to their employees, and they're always there for me when I ask for the favor or for the assistance. And so they said yes. I brought on local realtors and asked them, how can you help me, help us, help you? And they said yes. I brought on local legal firms that haven't seen a stitch of business in the real estate market, that understood the value of stabilizing our community, brought them around the table, and they said yes. I brought local retailers around the table that said, listen, if you help me, help you, help us, we all benefit. And local retailers said yes, and I reached out to state government and federal government and asked them to participate, and they said yes. And again, I would say this, as city manager, I'm blessed to have that type of response from a community that gets it, that we're all in this together, and I feel incredibly lucky and proud as I described this, that everybody said yes. The effort was designed to obviously counteract all the negativity and negative information about foreclosures in the housing market, because we knew we had qualified buyers, creditworthy prospective buyers that understood the reality of good loans that were prepared to buy and buy now. We just had to get them off the sidelines. It's been extremely productive, pushing responsible residential loans to responsible home buyers. I've got some 15 local banks and credit unions now involved, 7 legal firms, 8 major employers here in the city. It's an incredible success in the shortest period of time. I started out with a goal of a $70 million loan pool. I think I'm well over $100 million now because local banks like Commerce Bank and Trust. Brian was one of those individuals that when I first laid it out, competitive banks in a room sitting with me as I laid this out to all of them, And I thought for sure there would be, listen, we'll get back to you, let us think about this, and we'll have somebody on my team get back to your team. But Brian was one of the first ones in that meeting that said, yes, Commerce Bank and Trust will participate, and we feel lucky to be part of this program. Competitive banks in the room, and one by one, that yes followed. And I think that alone speaks volumes to how lucky we are here in our community. Unique products as part of Buy Worcester Now, 30-year fixed rate mortgages, less than what the market would charge, somewhere between a quarter point and a half a point. Again, getting that buyer off the sideline, waiving legal fees, mortgage insurance discounts, assistance to those who may lose their jobs. So as part of this, with that fear of job market losses and losing a job, having the insurance there to be able to back up a mortgage so people will understand that if they did lose their job, it doesn't mean they're going to lose the roof over their head. Lead paint assistance, counseling, making sure we're on top of that buyer from before the buy and after the buy to keep them on track. Purchase and rehab loans and bring these properties back to standard, all working with Mass Housing and Mass Housing Partnership to make sure that we have the proper backing and underwriting on those loans. It's an amazing process just with the banks alone. So far, we've closed on 60 homes. There's 100 applications in the process. We doubled the activity on soft second loans for first-time home buyers. Many of these are in foreclosed homes that we're working with. We tripled the attendance in the home ownership counseling side for creditworthy buyers, again, thanks to Fran Paquette. And we've doubled Mass Housing's activity here in the community in the shortest period of time since July. Since July. We'll continue this effort indefinitely, at least till I blow through that first $100 million. Then I'll go out and raise another 100. But it's proving effective and much needed to buffer the Worcester housing market from the global credit crisis. It's also demonstrating the strong relationships that really do forge community and the real productive interdependence that we feel between all these various sectors, whether it be our local employers, city government, state government, our local community banks, and citizens. Employers have stepped up. Incredible. Again, you bring them in a room and you ask them, will you participate? Will you help? Can we get access to your employee base? You benefit, we benefit. Can we use your human resource department? Can we train you to be able to understand this and be able to detail this to your employers? And the answer is yes, yes, yes. Hanover came forward, UMass Memorial, St. Gobain, our college universities, and the list goes on, to provide additional incentive to their employees. $5,000. Some companies are offering $5,000 to their employees as part of a package to buy Worcester Now. True partnerships to stabilize our neighborhoods. Retailers stepped up, Percy's, Rotman's, Hanover Theater. Again, just little incentives, little thank yous to say we're glad that you are part of our community, and we're glad that you've taken a stake in our community. Telegram and Gazette with a newspaper subscription for the first 3 months, and the good part about it is we get to black out all the negative news about the city because they're part of a partnership here. So we're using it as part of the propaganda machine. The next phase of work here is using federal, state, and local dollars that are starting to flow finally to assist us in this credit crisis. We've received an award from the federal government thanks to Jim McGovern and Senators Kerry and Kennedy for some $2.4 million, and we're putting together our plan to actually apply those dollars to bring properties back in our hardest hit of areas, primarily Maine South, Lower Vernon Hill, as well as Lower Belmont Hill. Right now, there's some 1,700 homes, as I mentioned earlier, in various stages of foreclosure and abandonment. We've also published a draft plan with HUD to use this money. The public comment period is for the next 15 days. It's on our website for anybody that wishes to comment. In total, the Commonwealth right now from the federal government's received $53 million. Worcester is eligible and expects that $53 million. I'm just joking. We expect a portion of that $53 million, again, to leverage additional monies from that allocation to go toward that $2.4 million and working with our private sector partners, even bring more money to bear. We've identified, mapped, and risk scored 3 distinct neighborhoods, as I mentioned, of our city where these funds will be targeted. There's 2 distinct programs as part of that. It's homeowner assistance to capitalize on the Buy Worcester Now program in cooperation with the state, and then it's working with developer assistance programs to get the proper investors and proper developers involved in stabilizing and bringing back our neighborhoods. Right now, the plan's approximately $20. That's just state, local, as well as federal monies. But then we're out seeking out private equity to leverage hopefully more than $100 million. Again, all these funds dedicate to rehab loans, down payment assistance, receivership, demolition, transaction of properties, including, and I'm looking into this, eminent domain to move these properties quick. We can't even get to who owns these properties in some circumstances because they've been bought and sold and resold so many times. Interim control to purchase, hold, and sell when necessary, so the city will actually be part of that. The comments are due by December 1st, and then we hope to negotiate with the state for their portion of funding and have the money on the streets by January 1st. Those funds aren't enough to solve the problem, but estimate over 100 properties alone with that federal money will be reclaimed from foreclosure, rehabilitated, and brought back to proper reuse. I would be remiss if I didn't thank the partners that have been working with me. Obviously, the City Council, their stewardship and leadership, the state administration led by our Lieutenant Governor Murray, as well as Governor Patrick. The efforts of our Congressman, Jim McGovern, has been tremendous, as well as our Senators Kerry and Kennedy. It is a teamwork up and down the line when it comes to government, as well as the other agencies that provided critical support to this foreclosure crisis, Mass Housing Partnership, Department of Housing and Community Development, all my key staff, the CDCs and not-for-profit housing partners here in our community, and all of our community partners that we touched on. One of the things, and this is from a personal level, I continue to be amazed at the lack of responsibility to those that created this mess, that insist that someone else bail them out of what I consider to be greed and recklessness in many cases. And they do so with the look of my 8-year-old, which wasn't me. And in the meantime, our community, our neighborhoods, the greatest assets we can point to, all types of homes, all types of housing to meet all needs, stable neighborhoods, owner-occupied homes, stable revenue, stable services, all could be at risk of being lost. And the problem's so overwhelming that it can leave the strongest of personalities curled up in a corner, sobbing. The track was set for a race to the bottom of the barrel. But what I can tell you here is no way, not here, and no how. It was a call to action. Do we have a monopoly on the ideas and for any way have this problem solved? No. But we're all ears. There will and must be a multitude of solutions brought to bear, and there's more that have to be brought to bear on the horizon. It must be quick and nimble. Decision-making paralysis in this case of the solutions of 1980 or 1990 or 2000 aren't applicable here in any way, shape, or fashions. It really is clear the decks and push. I will tell you that the palette of options will be required have to result in decisions fast. With literally walking slowly down affected neighborhoods where entire streets are abandoned and or foreclosed, and making decisions one by one. Literally saying, with a decision to say, we're going to transition this over to a CDC, we're going to negotiate with this owner, with the bank, to lessen their financial commitments, we're going to demolish this particular property, we're going to take this one by eminent domain, clear the title, and sell it to one of those pre-qualified home buyers, or we're going to shift this over to a pre-qualified investor. This has to be done. Decisions have to be made quickly, for we have far too much to lose. Thank you very much.
Good morning. It's great to be in Worcester to be talking about this because as the foreclosure crisis was starting in Springfield, we were coming out of and restabilizing over our own financial crisis. And we've really looked to Worcester in a lot of ways at some of the things you're doing here as models for things to do. So both the SAVE program and the Buy Worcester are things that have been models for Springfield that we're working off of and going forward with on our own now. I think one of the things that really struck me as I listened to Paul was thinking about how this crisis is so much talked about as homeowners, but in a city like Springfield, and I would guess Worcester as well, there's really an element that also is about investors, and it's not about homeownership so much, at least in the core cities. It's about rental housing, and it's about investors. For Springfield, it's really about quite a bit about outside investors. So we see the places where we have the largest foreclosure problems and the largest problems with vacant and blighted housing are all rental neighborhoods, very old housing stock, pre-1940s, lots of problems around maintenance, lead, all those things, very expensive repair to the homes. So we think, what we think we're seeing is investors walking away as the prices decline. Our values in Springfield are very affordable compared to the rest of Massachusetts. Although values increased 80% from 2001 to 2007, in 2007, the value of a single-family home is still $153,000. So I think, you know, anyone from the eastern part of the state says, boy, there's deals there. And there's still, you know, so I think one of our challenges as houses become available is making sure that that doesn't continue to happen, because we have so many problems with keeping code enforcement and keeping properties up when we've got outside investors. So as we're seeing, we are having about, in 2007, we had about 1,000 foreclosures. This year, we're on track to have between 1,200 and 1,300. Properties are selling, but they're taking time. So what we're seeing is properties are moving, but very often what's taking time is that we can't figure out title. No one can figure out title, and it's taking a long time to get title in a place where things can move. In that meantime, we have lots of problems with theft of copper and squatting and all kinds of, you know, blighting problems around the properties. So we are looking to do, as we move forward, we're doing many of the same things. We're really focused on preventing foreclosures. In our neighborhoods where we have homeowner-occupied housing, we're doing a lot of prevention and trying to make sure that we're stabilizing people there. The city has set up a foreclosure rescue fund to help where paying off arrears is what's going to help to renegotiate and get a mortgage that people can afford and can stay in. We've really done a big informational campaign to make sure that people know to be getting assistance. We're struggling to maintain housing through foreclosure, so we're also doing a lot with receiverships. We've done a lot of outreach to tenants, telling them to stay in, not to take cash for keys offers, but to keep the properties occupied. And then as we look at disposition, we are really looking to figure out how can we help Springfield residents own houses, because it really, the neighborhoods that are so impacted, we feel we really need to stabilize. You know, the federal funding is stabilization money, neighborhood stabilization money, and that's really what we see as an opportunity to stabilize some very troubled neighborhoods. We're recognizing that often the problem is affordability, so we're looking at soft seconds that really write down the cost for the buyer, but yet keep the purchase price at a level that isn't devastating the market. And we're looking at doing ongoing homebuyer education for people buying into the homes. So instead of just the courses up front, we're looking to support people throughout the first several years of home ownership. We have, I mentioned, we've really, much of Springfield has a high foreclosure rate, but the impact is very much concentrated on the neighborhoods around the downtown core. So we, like Worcester, have been concentrating city services, and we're really looking at increased code enforcement, increased fire protection, increased police protection, and we're combining, and that's where we're spending our neighborhood stabilization funds, and we're combining it with other significant investments. So we're doing street corridor reinvestment. We are spending a lot, we're concentrating a lot of our CDBG funds and in improvements in one neighborhood, and sort of several other things all going on in the same, there's a series of 3 neighborhoods that are next to each other. We're really looking to see what we can do to really impact that neighborhood, those series of neighborhoods, and really turn them. So again, I just want to thank you for the opportunity to be out here and to speak to you. Thanks.
Thank you very much. What a great program. We've got a lot of information. There's a lot to do. There's a lot happening. It's 9:15, which is the time that we had indicated the program would be over. So I think that what we should do is maybe take a couple of questions, and then our speakers will be here for a few minutes after. And then if you have specific questions that you want to ask them, then feel free to do so. So why don't we just, does somebody have a good couple of questions that they might like to ask? Yes. our mayor.
As I was listening to everyone, it appeared to me that the underlying current in public opinion is that there's a lot of unfairness in the solution of this problem. And Mike O'Brien raised it when he referred to fraud. And there's greed that would propel all of this crisis that didn't occur overnight. Probably started with Clinton's intent to provide everybody with housing and affordable housing. And that led to an underlining process of greed, profit-taking, and fraud. And you can't predict fraud in any formulas that you deal with as lenders. And that, I think, is the problem that was highlighted by Dr. Weiland's comments, and even though he didn't say it. The bottom line is, how do you put a Band-Aid by the bailouts, with the bailouts, on a problem that has much more significant underlying causes? And in our economy, where we depend on immediate gratification, when we depend on profit-taking, job creation, all of that is the basis for the condition that we're in now. And this is not rocket science. The public is starting to say the bailouts aren't working, you aren't solving the problem. We need to constrict lending and make it much more responsible. We need to admit that our job creation has to be 21st century jobs, so we have to gear ourselves in that direction. And we have to admit that there is not a right to housing, because those good intentions led us to this crisis, and the people that attach themselves to those intentions. And I'm a sole practitioner as an attorney. Nobody can convince me there wasn't fraud out there, because I saw it happening. I saw money being lent to people who clearly could not afford to pay for those properties they were buying. I also saw people flipping houses and generating more and more profits and more of these unsteady loans, because they were just plain greedy. So bottom line is, how do we really solve this problem instead of just bailing out those people that caused it and frankly aren't going to suffer the consequences of their bad behavior, which we are all suffering from?
I think that question is for Dr. Willen.
So, you asked a lot of different questions. So let me say, I mean, the fraud thing is definitely an issue here, but I think it is important, just as with the savings and loan crisis, you know, when you talk with anyone who actually was involved, the fraud is what got people's attention, but most of the problems, you know, that was 10% of the problem. 90% of the problem was just being in all kinds of being in the wrong place at the wrong time and just bad luck. And certainly in the case of the savings and loan, there was also there was a serious moral hazard problem. But let me just say that I think the mortgage market problems have more or less corrected themselves, in the sense that that I don't think anybody's making reckless loans anymore, and no one's making any loans anymore. And that pretty much solves the problem. But I think we've probably swung all, I mean, I think that correction has already taken place. I think the other thing, it's important to distinguish between the goal of higher home ownership and what happened in the last few years. I think whether you think that high rates of home ownership are a good thing or not is a separate question from what happened in the last few years. I don't attribute what happened in the last few years to a zealous drive for home ownership. House prices are rising at 10% or 15% a year. It's very, very hard to convince people that not to buy homes. I mean, people wanted to buy homes because they wanted to make a lot of money quickly, and they saw a lot of other people around making a lot of money quickly, and you say, you know, and they, you know, when people buy homes, well, one way you can pay off a mortgage is by making 30 years, you know, 360 monthly payments. The other much easier way is to sell the property and pay off the mortgage. And so it's hard to say whether, you know, a lot of people, there were a lot of success stories in the last 7 years. A lot of people who made a ton of money buying and selling homes. And a lot of those people have kept the money. I mean, they bought the house, they sold it 3 years later. They could never have afforded they couldn't afford the monthly payments. They never could afford the monthly payments, but they sold the property and did fine. So it's very tough. I mean, the problem was, and we don't really understand why house prices were rising as rapidly as they were. And people say, oh, it was the lax lending standards. It wasn't. I mean, the lax lending standards, in many ways, you see them appear after house prices had started rising rapidly. So I think there are a lot of things we don't understand about how house prices work and why house prices were going up so rapidly. But when you have a phenomenon like that, a lot of crazy things happen. It's the same thing that happened in the tech bubble in 1998 and 1999. So I'm not sure what we can do going forward. I think, as I said, I don't think we have any problem right now with reckless lending. On the contrary. But I think that going forward, we do need to, I think one thing that people need to realize is that house prices can rise rapidly and they can also fall rapidly. And I think one of the things that, the way we talk about it in statistics is to talk about tail events. I mean, events basically that look highly improbable. And I think so I went to the playoff game when the Red Sox were behind 7-0, and they came back, as you know. And I went home that night and I couldn't sleep, and I said to my wife that what upset me was that I'm just sick and tired of all these improbable things happening. Good or bad, I just want the world to start behaving the way it's supposed to. And I'm sick of saying, oh, that could never happen, and then it does. So I think that's one of the things about the house prices. It was everybody just thought it couldn't happen, and it did. And I think going forward, we have to pay more attention to those so-called tail events.
Roberta.
Yes, I wanted to ask the city manager, what is the cost to the taxpayers of all the programs that you put in place?
I guess I would shape it this way. What is the cost if we didn't put these programs forward? We're talking about multiple millions of dollars between local, state, and federal sources. And it's in a variety of grant funds and grant programs, primarily earmarks and otherwise. All told, again, it's in the tens of millions, but failure to act, the losses would be in the hundreds and hundreds of millions of dollars. Both from property values, revenue to the city, and tax revenue. You couldn't put a price tag on the loss of things that we hold so dear, like the safety of our neighborhoods, the quality of life that would be lost or otherwise. So I would characterize it right now in the tens of millions of dollars between state, local, and federal sources. It'll probably exceed over time by the description of the length of the problem to be in the hundreds of millions over that same period. And we look forward to that continued support from our federal and state partners.
One more question. Bill.
Got a question for Dr. Willen. I'm not sure if other people saw this on the news. It was the local news earlier this week, but they reported about a story that the Fed actually loaned another $1 trillion to $2 trillion of dollars beyond the $700 billion bailout. They said a lot of people didn't know about this. It didn't require congressional or Senate approval, and the Fed was not disclosing what these funds were being used for. And I'm wondering if you know anything about that. Is it real, or what the situation is?
Let me say now, I'm speaking. The Fed has a balance sheet. That's what we do is lend money. All this information is publicly available. Yes, the Fed's balance sheet has expanded, but all that information has been fully disclosed. That is we operate, so for example, these monthly, the term auction facility, for example, we lend $150 billion a month. That's the purpose of the Federal Reserve, the so-called lender of last resort. That is what the Federal Reserve Act compels us to do. In addition to that, even the Boston Fed, for example, has been involved in lending to money market mutual funds. Again, this is all absolutely, we've been, not only have we not hidden this, this is something that we're very, I should say, proud of. I mean, this is what we're supposed to do. The reason the Federal Reserve was created was the so-called lender of last resort. One of the purposes of the Federal Reserve, it got forgotten because it was this obsession with monetary policy. is to, in a panic, is to be there so that creditworthy borrowers can still borrow when no one else is available. And so, for example, for the money market mutual funds, after the Lehman collapse, one money market mutual fund was heavily exposed to Lehman, this reserve primary fund, and it made it impossible for people to withdraw their money from that money market mutual fund, and people started doing redemptions from lots and lots of different mutual funds. And so we put in place a facility to basically lend to those money, to provide liquidity to those money market mutual funds so that they could meet redemption requests without causing a panic in financial markets. That's the kind of thing that we are, that is the purpose of the Federal Reserve System. As I said, that information is absolutely public, and the only thing that we do not do is, in many cases, we do not disclose the identity of the person who came to borrow the money. Again, that's part of the purpose. The fear is that if you identify people who come to the Federal Reserve to borrow, that the stigma associated with coming to the Fed will mean that no one will ever come to borrow money from us. So that is one thing we're very careful not to disclose. But we have expanded our balance sheet enormously. That's exactly what we're supposed to do.
Well, on the basis of time, I think that we're going to wrap up. I want to thank our three panelists. It was very, very informative. Thank you all for attending. And we got a lot of work ahead to do for all of us, but I'm sure we're all up to the challenge. Thank you.